Okay, we're live.
Hey, everybody. This is Coach D here with TackleTrading.com. We're just going live now on the YouTube. Thrilled to have everybody out here. We'll give it a minute as we watch folks trickle in. We're going to be talking about how to protect yourself during earnings season, how to cover your assets, how to protect your investments and trades, and just really have a good general game plan for what we're doing out there when it comes down to trading and investing. So come on in, join us. We'll have a couple people popping on in. Good. I see some folks coming. Say hello in the chat. Hey, Ahmed, how you doing? Glad to have you here. Excited to have you. Let me go ahead and share my screen here. And I'm going to play our little disclaimer. Just per visual, just per regular business practices here. So let me go ahead and share that up and hit that play button for you. You have been officially disclaimed because, again, we're here for educational purposes only. Hey, Linda, how you doing? Hey, Try, nice to see you. Dennis, glad to have you. Linda, welcome, welcome. This is awesome. And we got Mika here. Welcome, welcome. Eddie, great, glad to have you. Yeah, catchy disclaimer. This is the catchiest one you'll ever come across. So welcome out, everybody. We're going to be talking tonight about how to cover, we'll learn how to write one of these days, cover your assets. How do you spell assets? 2 T's, 1 T's, all S's, assets. During earnings season, I don't know how to spell. That's one thing that's probably my biggest personality flaw, is the fact that I can't spell anything. So if you put the right emphasis on the correct syllable, you're going to learn how to cover your assets here in tonight's webinar. We're going to talk about it from a basic level for the newbies who are brand new. And we're going to work up and talk about some of the little bit more sophisticated stuff. It's in the title, assets, right? Like, I know it's there, and I can kind of spell. I've got spell checker. I'm the guy who's got red lines through all my emails. I've got to figure that out. But welcome out, everybody. Glad to have you here. And we'll just go ahead and dive right in. Now, we are getting a little bit deeper into earnings season. We've got quite a few companies out reporting. I was just here on the Tackle Trading website just moments ago, and just going through our newsletter this week. We've got quite a few candidates, big fish reporting earnings this week. And we've seen a few of them already report. Some of the big, banks have been reporting now. And we've got a nice little list of things on the watch list in addition to all the regular analysis we do. Some of the big fish that are still reporting this week. Tomorrow, we got Domino's Pizza, Netflix, Bank of America, Johnson & Johnson, Abbott Labs, Morgan Stanley, Schwab. To name a few, and then you got a few more coming out on Friday. And again, today we had a few reporting, Goldman Sachs, US Bank, Alcoa. I'm used to seeing Alcoa report first because, AA Alcoa alphabetically. But let me change that up so I can see that. Okay, perfect. All right. So first question I have for you guys, and there's a little bit of lag between me and the live YouTube scan, so I'll try to keep up with that. Hopefully it's not too bad. But when it comes to earnings season, how many of you actually trade through earnings, like with investments? Like, you have stocks you own, maybe longer term investment strategies, even option strategies where you're willing to carry through an earnings announcement. I want you to type into the chat there, let it ride. I want to let it ride during earnings. If that's you, just kind of give me an idea. And if you're on the flip side of the coin and you try to avoid earnings, you can say sit it out, type in sit it out. If you avoid that, particularly for like swing traders or short-term traders that don't necessarily want to carry a position through earnings. Okay. And I'm kind of like you, Linda. What I do is if I've got longer term investments, I'll typically look to buy insurance on them prior to, or I will occasionally batten down the hatches on a position using something like a protected put or a collar or something like that to reduce the risk on the trade. Other trades I'll try to adjust prior to earnings if I want to write it through, but then I don't initiate new trades. Like if I've got just a couple of weeks till earnings, I won't put new trades on unless I got at least 2 weeks time before the earnings announcement. And then depends on where I'm at on the position. And, we want to talk about how to go about protecting that. Now, we'll start out with some of the simple stuff, like what do you do if you own stock? And one of the first things you can do is when you purchase stock, if you can purchase in what they refer to as round lots, meaning 100 share increments, if you can buy in round lots, then you can protect that asset really effectively using options. And that's something that we want to talk about here. And then we'll continue our conversation through the evening. We're going to talk about not only just how to protect it, but how you can also speculate around an earnings announcement. And just some of the things you can do, just make sure you really understand kind of the nature of the beast, so to speak. So again, good. Looks like I've got a few more people trickling in here. Glad to see you here, Adi. And a few others. Don't mind if you just type hello so I can get a better picture of who's all here. Just thrilled to have you. So let's dive in and let's talk about some of the basics at first. And I'm going to start out with just a real simple introduction. The put option. We're going to start out with, what is a put option? So we'll start out with a put option. Now, a put option, in the simplest definition of the word, it's a contract. Okay. So it's a contract, and it's a contract between a buyer and a seller. So again, this is going to be a review for some of you. I know a lot of you seasoned Tackle Pro veterans. Don't fall asleep on me because I know you know this stuff. But for those of you who are new to us and just getting to know us over at Tackle Trading and new to trading and investing in general, this is for you because this is easy enough to understand. So we got a contract. So we'll call it a contract that is legally binding. And when you buy or sell that contract, it's as good as putting your signature on the line. And it's a contract, again, between a buyer and a seller. So let's imagine for a moment that we have two active traders, and I'll put myself in this equation. I'll say that this is me, Noah, he's pretty cool. And then we'll say that Adi, you're here. I'm going to have Adi be my volunteer. You just volunteered, Adi. So you're going to be over here. Okay. And this is Adi. Okay. So yeah, repetition is awesome for learning. Now, if I own a stock, what's a stock you like, Adi, by the way, or a stock you own by chance? Why don't we go with that? Like, I think we could probably pick a few that everybody likes, like Apple or Microsoft or something like that. That'd be easy. But if you've got a stock that you like, Adi, we can talk about that one. So if you pipe that in the chat, let me know. Otherwise, I'm going to run with Apple. Apple, hey, there you go. It's like I planted that seed in your brain and you just gave me the answer I wanted to hear. Starbucks would also have been a good candidate. Okay, so let's say that Adi owns Apple. Okay, so actually I'll say that Adi owns Apple. So he has an asset sheet. Okay, and he's got assets and liabilities, and he's got income and expenses, right? And if he owns Apple, that could be one of his assets. So he's got Apple. Okay, so if Adi owns Apple and he's got, let's say he's owned it for a couple of years, he's got a decent cost base on it, and he always likes to carry through earnings because sometimes Apple has good earnings announcements and the stock price goes up. but he likes to cover his assets just in case Apple has a negative report on earnings or, lowered guidance or something like that, and Apple stock price drops. And so Addy can buy this contract. He can buy a contract. We'll just put a little picture of the contract in there. And we'll call it an Apple put. So we'll call it an Apple AAPL put. Okay, so he can buy that contract. Now, Apple, just to kind of paint the picture here, does have earnings coming out. So let me pop open Apple here. But they don't report until about the 30th of the month. Okay. And so right now, Apple's just ripping up strong. It's trading out here just shy of $400 a share. And let's say Addy's owned this for a while and he's got a $300 cost base or something in that ballpark. And he's really happy with his returns right now. He's got a nice little gain going on. He, hoping that can continue to ride and that trend can persist. And at some point in time, Apple may go into a correction again with that earnings announcement. We don't know whether it's going to be going up, down, or sideways. And in my opinion, one of the best times to purchase that insurance is a couple of weeks before earnings. And there's a reason for that. The options, that contract functions like insurance. Okay. And that contract, see, if Addy owns Apple and he buys the put, I could be the one who sold it to him, and I'm selling him a promise. Okay. So if you've got, Geico as your insurance company, every month or every quarter, however you pay your insurance, you purchase insurance and you pay that premium and you send it to Geico, to the company. And then Warren Buffett, out of the kindness of his heart, based off the contract that you have with them, will promise to give you fair value or the terms of the insurance policy. They'll cover you up to the deductible on your car, on your home, on, whatever it is you've got. So that, you could say it's car insurance or, home and auto insurance. They bundle it all, I hear. But you get that promise. And so he can buy that put, which gives him a right when he owns that contract. And that contract is an asset to him. And if I sell him that put, well, over here is my balance sheet. And over here, if I've got my balance sheet and these are my assets and these are my liabilities, that contract that I sell him, he's going to pay me for it. But that contract is a liability to me. So I get the income from the premium he purchases, but I have an obligation. So to me, that promise is an obligation. But Addy, he has a right, but no obligation. Or in other words, he has a choice. And there's another word for choice that you've heard quite a few times already tonight, that he could exercise that choice. What do we call that? It begins with an O. Let's see if anybody can guess what that contract gives him the right or the choice to do. He has an option. He has an option to sell the stock at the predetermined price on or before a predetermined date. So he can buy an insurance policy. In fact, this is why I believe options were created, was to create a form of insurance for investors. And then it becomes a tool for speculators as well. So he can go ahead and buy that. So if we were to go look at that, and I happen to have a good example on this, and I want to talk to you about, the time to buy those puts and how to go about it, and just how to think through that process. So here's an example I happen to have already set up. And here's one where in this little paper, this is a virtual portfolio, by the way. This is not a live portfolio. This is a virtual simulated portfolio. And there you go, simulated trading. But in this little simulated account, there's 100 shares of Apple, and the purchase price was $243.26. So on this little risk graph right here, this is $0. This purple line represents the stock. That $243.26, that's the break-even point. And this current stock price is up here just shy of 400 bucks. And that's a, 14,600 some odd dollar gain. That's pretty nice, right? Not too shabby. So now if Audie wanted to buy some insurance, and I'm going to see if you can respond to this, Audie, in the chat here. If you were to buy some protective put insurance, do you want to buy at the money insurance? Do you want to buy out of the money insurance? Do you have a preference? Do you want full coverage, or do you want coverage with a bit of a deductible so it keeps a lower premium? What kind of idea would you like, Audie, if you were going to buy insurance on Apple? Do you have any rules for that? Because I know you've got some experience with it. And again, just out of curiosity there. And if you respond in the chat, so you're going to buy out of the money. Do you have a preference about how far out of the money you go? And what that means is you're going to buy a lower strike price. And you can, most traders, like, it depends. Like if you go through, you read some of the books out there, they'll tell you to buy about 10% out of the money. Okay. And so that means if Apple is a $400 stock, 10% of that is going to be 40 bucks, right? So, that would certainly do the trick. Okay. So $40 out of the money. So that means if it was trading right here near 400 and he would want to buy some insurance, he'd be buying somewhere down around 360 or somewhere in that ballpark. And, which strike price you choose is up to you. In the example I put together here, yesterday I purchased I set up a put option at 370 strike price. So in this case, the person owns the stock at 243, has a right, or this person would have a right to sell that contract or to sell that stock at $370 per share. And that insurance costs $9.25 per share. Each contract's worth 100 shares. So he'd be into that contract 925 bucks. And with that, the risk, what happens here is it's going to preserve the risk. So if you purchased the right to sell it at 370 and the stock price goes anywhere below 370, you would have coverage below 370 as long as you paid that price. Okay. So let's go ahead and drop that in. Now this contract is good just through earnings. It goes through August 14th. So August 14th, their earnings announcement is here July 30th. So you got a couple extra weeks coverage. And you could buy more coverage if you want. Like you could buy multiple months of coverage. You can buy a couple weeks coverage, whatever you need. You have options. So you go to the options chain. Let me clear that up real quick. And these are all the choices you'd have for those Apple options, those put options. And you could go out and you could, purchase insurance out through October. You could buy insurance through September, whatever you really needed. And what I did is I said, okay, hey, if I know that earnings is out here on the 30th, and there's a reason I purchased it a couple weeks in advance, which I'll tell you here in a moment, I would say, okay, well, I could have done August 7th and I went all the way out to August 14th. And the strike price I chose was the 370 strike. Now, 10% out of the money would put you somewhere down, maybe even 360. So you could have bought that. I decided to go with the 370 and I basically kept the purchase price. I was trying to keep the purchase price under $1,000 so that it would reduce the risk. And so in this situation, this is a nice thing to do. And you have to kind of consider it. Like you're sitting on a really nice profit on Apple. Like you got this, big old fat profit on that, you're at 14,000 some odd bucks. That's pretty awesome feeling. Well, if you wanted to protect that and avoid, giving those profits back, it's not a bad idea to go spend, in this case, 925 bucks to purchase that insurance. And what happens is when you purchase that insurance, anything below the 370 strike price, you're covered on. So if it went down to 360 or 350 or 340 after, let's say they had a really bad earnings announcement and the stock price, instead of going up, let's say they forecasted that sales were off, blah, 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 2020, coronavirus, you name it, whatever the reason is. And they have a surprise, and all of a sudden the stock price gaps down below 350 and maybe starts to run back down towards 325. You got a little bit of risk. And that wouldn't be that unheard of. Just look how far it dropped back in here, back through February, March, when everybody was initially spooked about the coronavirus. I mean, it dropped pretty dramatically. So what if you got, kind of a similar kind of drop? Well, that could put you, as far down as like $300. And if you did that without the insurance and the stock price went all the way down, and what I'll do is I'll set up a few of these price slices. I'll set up a couple of these. I'll set this one down at 300. I'll set this one here down at 320. I'll set this one here at 340, kind of going in 20-point increments. And I'll just add a couple of more strikes. I'll add one at 360 and then 380. I'm just going to go in about 20-point increments here just so you can kind of see that. And then that's the current price right there. So let me just add one of those back in. And I'm going to reorder these in descending order. So I'm going to reorder these slices by price. So it just puts them from highest price down to lowest price. Okay. So in that ballpark. So again, this is, 300. This would be if the stock price dropped down to 320, 340. And I'm just evening those prices out, 360 and 380. Okay. So this is what would happen to your profits. If you still have profits, but you'd go from being up 14,000. If it dropped down to 380, you'd be at 13,670. You'd be at 11,674. If it went down another 20 points, you'd be giving up, $4,000 or $5,000 a gain. You'd be at 9,674. Another 20 points. It could wipe out quite a bit of your profits, and it could go down far enough where you could even start losing money. But if you'd be willing to spend a little bit of money to protect your assets, I want you to watch these numbers and how they change. Now, in order to do this in this example, this put option is going to cost $925. So you have an expense, which does come off your top line. So your profits, the minute you spend that money, that changes your current profit to, because you do have an expense. Now, check out the difference in the capital preservation. Okay, I'm gonna check those and recheck those. Let me kind of just compare and contrast for you with and without. So without protection, you could see your gains wiped out all the way down to where you just have $5,000 in gains left. But with the protection, you can keep that up close to $12,000, $11,840. If the stock price were to drop, down to 360, you'd still be up 13,000 instead of being up just 11,600. So the insurance starts to protect you. And if I show you the put option contract without the stock involved, you'll actually see what happens is the stock price starts to drop, you'd actually start to make money on the option. And then you have the right, in this case, to sell the stock at 370. So anything below 370, you would have coverage on. So you would get complete coverage if it dipped down below 370. And at expiration, it would maintain, you'd be guaranteed at least $11,749 of profits. So it eliminates your fear, lets you sleep at night. And I personally find it important to, if you own the stock, to buy that insurance a couple weeks in advance. And there's a reason for that. Let me go show you that over here. I'm going to show you a little indicator we use over at Tackle Trading called an IV rank indicator. And what the IV rank indicator does is it tells you when the options are more expensive and when they're more cheap. Now, back in March and April, we had extremely high implied volatility. So for you to really get a good feel for this, I'm going to go show a couple years worth of history. I'll go show 3 years worth of history. And then I'm just going to show the data prior to the February meltdown for coronavirus. And I'm just going to show you that so you can kind of see there's a little cycle here where these little telephone icons, these little red and blue icons on the chart, those are the earnings announcements. And what you'll notice is as earnings comes out, the stock price can move dramatically on the chart because they announce new information. and the implied volatility goes up, and up here it got up to like 29, 30% implied volatility. So that means the options were a little bit more expensive. And then earnings goes away and the implied volatility will drop back down. And about 4 to 6 weeks in advance before earnings, it starts to rise again. And then by the time the next earnings announcement comes out the next quarter, that implied volatility is back up again. So they're more expensive. And then the earnings announcement passes and it goes away, and the measure of implied volatility or risk expectation goes away, and the options will get cheaper again. And then about 4 to 6 weeks before earnings, the implied volatility will start to climb. And then right before earnings, you see higher implied volatility. And then boom, that stock price, it can move up, it can move down. Like you can see it move both ways. Like here's where it moved down back in February of 2018. And then by, April 2019, it was moving up. Okay, move forward again, quarter over quarter, you'll see that implied volatility rises into earnings, drops afterwards. Rises into earnings, drops afterwards, tends to rise into earnings, drops afterwards. So the general idea here is when you're buying your insurance on a stock, if you wait till 1 or 2 days before earnings, you'll end up paying a bigger premium. If you buy that insurance, if you bought the insurance last week, you would have gotten a slightly better discount. Buying the insurance this week, it's telling me it's yellow. It's a little bit more expensive, but it's not outrageously expensive yet. But in the next 2 weeks, as we get closer and closer to earnings, that implied volatility is going to continue to rise on average, is what we would expect. And that means if you waited, you could end up paying more. The stock price could stay in the same ballpark. You could end up paying more for the same type of policy. So my personal rule is if I can buy that insurance, I want to get it at least 2 weeks in advance. If I can get it, 2 weeks to 4 weeks in advance, even up to 6 weeks, which is, halfway between earnings announcements, you can buy your insurance ahead of time and usually save a little bit of money on the premium. Now, so that's important. So you can buy that insurance. Now, sometimes if I don't, like right now, I have a pretty bullish outlook on Apple and the tech sector is pretty strong. And even though I've got my concerns about the economy, just like everybody else does out there, as we're watching how we're managing, the coronavirus and the economic shakeout from that. But the general idea is we want to make sure that we are covering our positions and assets prior to those earnings announcements. Now, if I wait too long and the options are expensive and I don't want to just spend the money on the inflated premium, I will sometimes collar the trade. Instead of just buying the protective put, I'll sell a contract myself, a covered call, to help me pay for that protective put. And that means you'll give up some of the upside trading potential for profits in exchange for money to cover the downside. So, and that's something you can also do. And so in that case, if this was Addy's stock, he has the choice and I was the one who sold him the contract, I have an obligation. I'd be the one who covered him if the stock went below the 170 strike in this case. So if it goes below 170, then that's my liability. I promise to take that off his hands. Now, if Audi wanted to get some money to pay for that contract, he could sell a second contract. He could sell a covered call. And that would be on his liability sheet. Since he owns the stock, he could sell the little covered call and he could get an income. He could get some money from that to help him cover the expense and pay for his insurance. Now, in this example, the insurance cost $925 to protect the nice, $14,000 gain on the stock. And if you were okay, if you weren't, if you're more worried about protecting your gains and you weren't as worried about keeping the upside potential, and if you were thinking the options were too expensive, I'll show you how that works. In this case, spent $925. A real simple thing you could do is I could just go find the first call that pays 900 and something bucks. So I could go out here and I could say, well, I'll promise to sell the stock out at 415 if I can collect $925. Now that's right on the top end of that option price right there. But just to make the math easy, I'm going with that asking price. So if he got paid $9.25, that income would cover his expense. Now, this will cap his gains if it goes above 415. So if you look at that, this creates what's called a collar, and it puts a top on the graph, and we already have the bottom on the graph. So if the stock price ran up, he could still make money, but it would cap out his gains at 17,000. So it cap his gains at $3,000 higher than he is right now. Yeah, it would be a credit. Well, it'd be a credit to your income, and then you could put it in your asset column, Adi. So if you think about it that way, like if you sell the call, and this one we'll say is a call, just to clarify, and then we'll call the other one the put. Okay. And so he bought the put, which was an expense. So that was $925 expense. But when he sold the call, that's a $925 income, or $925 per share. Does that make sense? And so it's a liability to him. Now he owns the asset. He owns the stock. So is he covered on that liability? He'd be covered, right? Yep. So you could use the call to help pay for the put. And that creates what's called a collar. So, when you own the stock, so if you have the stock, let me pick a new color here. If you have the stock and you buy the protective put plus a protective put, he's covered. So his risk graph for the stock looks just like this. And when he buys the protective put, he gets to buy a put option, which has a little risk graph that looks like this. It has an expense, and then he's covered to the downside. If you add those two together, you wind up with a risk graph that has a bottom, and it goes like that. So this is, let me separate those out. Stock, put, that is a protective put when you own both. So let me just show you that on the risk graph. Then I'll erase those so I can come back and recoup that. But let me show you that. So again, just the stock risk graph goes up and down at a 45-degree angle. He's got unlimited upside potential, and his break-even points, the purchase price in this case was $243.26. That's the cost base. So then if he buys the protective put, boom, that puts a floor in. He's covered anything below 370 because that's the strike price. That's the agreed upon price in exchange for the premium. So he's covered below 370, got the 925, covered to the downside. Take the stock out of the equation. And if you just were a speculator, you could buy the put. You don't even have to own the stock. You can just buy the put. And you would benefit if the stock price dropped. If it went below 370, 360, 350, you would actually make a little money on just the contract. You could sell the contract for more than you bought it for. Okay. Combine those together. That's a protective stock position, protected stock. And selling the call puts a cap on that. Now, if I take the protected put out of the equation, that's what a covered call risk graph looks like. Put them all together, stock with a covered call to pay for the protected put, that's called a collar. And it caps your risk down to the downside. In this case, you would be guaranteed to make at least $12,674 if it went below 370. But if it went out above the upper strike price, the 415, that's where it would cap your gains, because you promised to sell the stock at 415, or if it went out or above 415, they'd take it away from you. So your gains would stop. Okay, so let me read the question there on Guitar Flip 808. I want to break your name down, Guitar Flip 808. You play the guitar and you live in Hawaii? I don't know. I'm just guessing. If you color the stock and then it goes past the short call, if you want to hold the stock, you'd have to buy the call back prior to expiration. So sometime between now and the 14th of August, if it went out above 415, you could technically get exercised anytime between now and expiration. They could take it away from you at any time. But statistically speaking, you won't get called out until the expiration date. There's probably 90+% chance you won't get called out until the expiration date. And what you would then do is they would exercise, you would deliver the stock automatically. The broker would just take it out of your account. They would pay you the agreed upon price, $4.15. And so you would end up just with the profit and no stock in your account. But if you wanted to hold on to the stock and the stock price is moving up, you would have to buy the call back prior to expiration or prior to assignment at any time. And that's 90, probably 95+% of the time. Early exercise and assignment doesn't happen. It can happen, but it's not statistically likely. Anybody here ever been exercised on early? If you have, type in early exercise in the chat. It happens, but it's statistically not very likely. Yeah. And so then what would happen is you would have to buy the call back to get rid of your liability or the promise you made. And it would probably cost you more than $925 to buy it back. So you sold it for $925, and then imagine it cost you $1,500 to buy it back. Well, then you'd be out of pocket $575 to cover that. Does that make sense? You'd have to pay to buy the contract back, and you can buy or sell the contract at will. So when you buy the put option, you can buy or sell. You can, sell that or buy it back, whatever you want at will, up until expiration date. When you're the purchaser, you're the one who has to exercise. If you're the seller of the option, they have to exercise on you. So that's why it's kind of random. And it happens occasionally. You will get assigned early. So we had Paul Liu said he's been assigned early or had exercise, taken out, and same with Majid. So it's happened to me as well. And I always thought it was a bit of a surprise. And I've had it one time where it was like weeks before the expiration date, I got exercised early, which was kind of surprising to me. And then every other time I've had it happen to me, it's been like 1 or 2 days before earnings, like right there, usually on expiration Friday or expiration date, the last day you could trade the option. So that's a protective put and a covered call. Now, again, I know we got a good group here, and I recognize a lot of your names. I know we got a lot of Tackle Pro members here. Is anybody here new? Anybody here brand new that's not a tackle trading pro member or hanging out with us on a regular basis? If you're new in the chat, type new. You got a whole month before in 2000. That's interesting. It happens. Like, again, it can happen. And that's why it's important to understand those options, because the contract is you promise to buy or sell the asset at a predetermined price, the strike price, on or before, anytime before the predetermined date. Hey, welcome, Leanne. Glad to have you here for the first time. Hopefully you're learning a little bit of something about the idea of buying protective puts. So in summary, you can buy the puts at any time prior to the earnings announcement. You'll find on average, you'll pay less in premium if you do it at least 2 weeks in advance. You can get somewhere in that 2 to 4 weeks before earnings. You won't pay outrageous premiums. And if it's right before earnings, you can still buy them. It just means you're going to be paying a little extra for that premium. And if you want to get some coverage to help you pay for it, you can sell a call against your stock. So you own the stock, you can sell a covered call, get some of the cash, and pay for the insurance. And that's a great way to go. It kind of neutralizes the trade. Now, would it be okay if I showed you just a slightly more advanced trick where you take the same concept, the caller, and you completely neutralize your risk? Okay, I'm going to show you guys how to do a synthetic short, or take the caller. And this would be what I would refer to as battening down the hatches. Now, have you guys ever been in a storm where you can see the storm coming, or you can see the weather service? Particularly those of you who live in, I'll allow it. Thank you, Guitar Flip. I like it. I'll allow it. Where the storms are coming. Maybe it's a hurricane warning or a tornado warning, or you just get here where I live in the Rocky Mountains, we typically just get seasonal storm warnings, thunder, flash flood warning, stuff like that. So you get the warning, that the earnings announcement's coming in advance. And if you just want to batten down the hatches, meaning you're happy with your current profits, you're not too worried about upside gains, and you just want to eliminate the downside risk without having to sell the stock, you can use strike prices right at the money, or you can use any of the same two strike prices. So I could go here to the same August 14th, and we could go in and say, okay, well, the stock's trading right here at 390. That's the current price. And a lot of times the pricing works out just right. Sometimes there's a small discrepancy, but it looks like you could sell the 390 call and collect somewhere around 19 bucks. And the put, to purchase the put, it's going to cost you somewhere around 1820, 1840. So you can actually get the same strike prices. So right here, the same strike price, get enough money to pay for the protective put. And this creates what's called a synthetic short. So you go and say, okay, well, I'll sell. In fact, I can go here and we'll go analyze, sell, and I'll do what's called the synthetic combo, collar synthetic combo. And then that'll just take the 390 call, you're selling the call and the put, and you'd wind up with a 60-cent credit at the end of the day. So you would get paid 60 cents to flatten your risk. And when I say flatten your risk, I mean flatten your risk, like it literally flattens it. So I'm going to go analyze that so you can see it on the risk graph. And I'm going to show you just the long stock. And I've got just this combo checked here where it's selling the call, where you're promising to sell the stock at 390 between now and August 14th. And then you have the right to sell the stock yourself at 390. And you'll notice the risk graph goes flat. And you got that purple line squiggles a little bit. But the difference between, the top and the bottom, that's like $100. Like between that purple line, it's like a $100 scale there. And that'll flatten out over time as you flatten it out. Now I'm going to take and just make you look at the stock risk graph one more time. 45-degree angle. Your net delta on the position is 100. So you have 100 shares of the stock. So if the stock price goes up $1, you make $100. If it goes down $1, you lose $100. That's simple, right? Now watch just the synthetic. When I show just the synthetic, I take the stock out of the equation. I'm going to show you just the synthetic combo. And that looks like the mirror opposite to the stock. It's like a 45-degree angle, that way. And its delta is negative 100 ballpark. And it'll be right around 100. It'll sometimes be 99, 98, 100, 102. But it's right there in the negative 100 zone. So it's called a synthetic short is what it is. And when you sell that call and you purchase the put, and it's at the same strike price, you basically have made a promise to sell it at 390, and you have the right to sell it at 390. And then if you already own the stock, boom, it flatlines you. It takes your delta down to almost zero. So you're now neutral. And the stock price could go up and you'll still keep your $14,000 gain. If the stock price goes down, you'll still keep your $14,000 gain. If you already own the stock, there is no BP effect because you already own the asset. Does that make sense? You've already got your money tied up in the stock. And since you already own the stock, you're covered on the covered call and you own the asset and you have a right to sell it at 390, but no obligation. So there's no BP effect for the put. But there is, if you sold just the call and I didn't own the stock, yes, there would be, in this case, looks like about a $9,600 BP effect if you didn't own it, which is probably cheaper than short selling the stock itself. Now, you can't buy it long and be short the stock at the same time. That's why you have to use the options. But that collar, that synthetic collar, when you put the stock in the equation, it just flattens your delta out and you'd have time to unwrap the trade. Earnings is on the 30th and those contracts are good through the 14th of August. So you'd have time to unwrap and get rid of the options and still hold on to the stock. So the idea is you batten down the hatches for a pending storm, if it's coming, and you protect that asset, you cover that asset, and you ride through the earnings announcement. You sleep beautifully that night. You don't even think twice about it. You observe the earnings. Oh, it went up. Oh, it went down. Oh, it stayed the same. It doesn't really matter what the outcome was because you flattened your risk. And then you watch your chart and you time it and you try to buy back the options. So what happens is as it goes up, you'll win on the stock, but you'll lose on the options. You'll break even. And if it goes down, you'll lose on the stock, but you'll win on the options and you'll break even. You'll keep your cash. And so it completely neutralizes your trade. Makes sense? So that's a fun way to go about covering and protecting that asset. So again, that's owning the stock, buying a protective put. And you can buy that protective put at any time. A lot of investors, if they're really particularly conservative investors, they have another term for a protective put called a married put. So if you go read some of the fancy books on options, like, Options is a Strategic Investment by Lawrence G. McMillan, or, there's books that are pretty advanced on options, and they'll talk about married puts. Well, all the difference between is a protective put and a married put is if you bought the put at the same time you bought the stock. So if there was a new stock, anybody have a new stock they're interested in bullishly, or a stock that we haven't been talking about that has options, mainstream stock? If there's anything out there you're interested in, I could always pick one out of a hat, but I always like to see what you guys have out there, whether we could switch gears and look at Microsoft. I was recently just looking at NetApp, or Net, which is Cloudflare. Okay, DraftKings. We can talk about DraftKings here in a minute. They may have some. I'll look at those too. Ulta is a good one. I like VIPS a lot, Linda. I'm going to go with VIPS. And I'm just picking VIPS because I like its chart today. Because, hey, it's in an uptrend, higher highs and higher lows. It pulled back down to the 20-period moving average, kind of making that higher high, higher low pattern. Still in an uptrend. And it's a $22 stock. So you could do a married, protective put at the same time, where you can buy the stock itself and, pick it up at the current price. In this case, let's say I wanted to offer 21.65 and go create that order. And then I can, at the same time I'm putting on the trade, I can do a blast all or a first trigger sequential. I usually would do that one, or first triggers all. And then I just go buy the put I want. And let's say I wanted to buy long-term insurance through November. Like I just wanted to cover my asset. I was willing to, I'm buying the stock here at 21.65. And another great way to think about the insurance is, and really when it comes to trading options, by the way, if you're new to options, I think one of the easiest ways to understand options is to just use analogies for insurance, by the way. And if you're new to this stuff and you want to learn more about options and protecting your assets, let me show you guys a little something here. Before I had the Tackle Trading newsletter open, I was showing you that. And our pro members have access to all kinds of awesome little courses, and we offer a 15-day free trial for you. If you go under the courses, and if you look at that, we've got like Technical Analysis 101 and Options 101 course, where if you're brand new to the stuff and you want to go through and get all the foundational essential information you need for technical analysis, for options, even futures and Forex, we got like an Options 101 course that is absolutely awesome. You can go through and you got video training, you got 4 modules that walk you through and introduce it to you. And you got quizzes and things to interact with. It just teaches you all of the options, essentials. I mean, absolutely everything you need. And so you can get that. You can sign up for you go to our homepage, tackletrading.com. And we have a 15-day free trial, risk-free trial, and you can check it out. And we always have our little 15-day free trial. You can just go to the homepage and start your 15-day free trial, take those courses. And if you like what you're learning, great. Pro membership's $97 a month. If you're not thrilled with it, that's okay too. Take the classes, get the learning, and move on. I'm pretty sure you'll like the classes for those of you who have done it. And, we've got out of the folks here, I'd say the vast majority are our faithful pro members. And again, we're trying to invite new people and get them excited about it. But you can go take those courses like Options 101. It talks all about what a call is, what a put is, what the Greeks are, and just some really, really good foundational information. Now, when I say learning options is really cool because you can just equate it to insurance. How many of you have insurance? I mean, all of us have insurance somewhere in life, right? whether it's home insurance, auto insurance, life insurance. You can equate insurance. So it's real simple stuff. Like, which would be more expensive to insure, a Honda Civic or a Range Rover? You kind of go, oh, well, which one's more expensive? The more expensive the car, the more expensive the insurance, right? Okay, well, which would be more expensive to insure? A Dodge minivan that costs $50,000 versus a sporty red Jeep that also costs $50,000. Dodge minivan, $50,000 price tag. Shiny red Jeep, $50,000 price tag. Which one's going to have a more expensive insurance premium? It'd be the Jeep, right? You guys get that. So, and the reason is because the Jeep does fun things, like you can drive over stuff and you can take the top off, and people tend to do more interesting things in Jeeps. Depends on the minivan too, really. But partly depends on how the driver is, but part of it's the car. So now so the Jeep's more expensive because it's more risky or volatile. Well, let's say that you have a 35-year-old female with no moving violations in the last 10 years versus a 17-year-old male who also has no moving violations. Who's going to have the more expensive premium? The 35-year-old female or the 17-year-old male whose frontal lobe has not completely formed? And everybody knows that, that teenager is going to be more expensive to insure because they pose greater risk. Right. So it's more volatile. So the premium goes up. Okay. Now, which would cost more insurance policy wise? Zero deductible insurance where you get full coverage, or having a $1,500 deductible? Which one will cost more? Full coverage, no deductible, or a policy with the $1,500 deductible? When I was 17, Zach, I thought cars were for jumping. So zero deductible is going to cost more. So what we were talking about before is when you buy the out of the money put option, that's like buying with a little bit of deductible. So if I purchased the stock at $21.65 and then I turned around and bought $20 insurance policy, that would have a $1.65 deductible. Does that make sense? Or if I went and bought an $18 policy, it would cost less. I could pick up that policy. We could pick up that policy here for we were going clear out to November, right? November. You could buy that $18 policy for $1.55, $155. And your deductible would be between $21.65 and $18. So you'd have a $365 deductible. I like the way you think, Zach. That new Bronco looks pretty sexy. I've already priced them out. But I also need a truck to pull the boat, so I was also pricing out new trucks. Kind of fun. But you get the idea. So those insurance deductibles, you can go as far out of the money as you want, but at a certain point in time, the average wreck, if I end up with like a $500-600 deductible on a $21 stock, I won't be paying much for the premium, but I'm not getting a lot of coverage. Does that make sense? So if you bought that one, and if we were to analyze that trade, I can go analyze that. You can look at the risk profile there. Now, this is another way to think about it. This is kind of a fun one. So, and I'm going to teach you another trick real quick here. I think you guys will like this. If we buy the stock, 100 shares at $21.65, what's the cash outlay? Let's imagine you're in a cash account. What's the cash outlay for a stock at $21.65? 100 shares. 2165 times 100, $2,165, right? Okay. So you'd have $2,165 and the stock, the risk goes all the way down to zero. You could lose all $2,165 if the company went out of business. Now, to buy that insurance, it costs you an extra $155. So what's 2165 plus 155? 2165 cash outlay plus 155. You're now into it 200 or 2,305 bucks or something like that. Did I do the math right? I don't know if I did the math right. Close enough. Somewhere in that ballpark. So your cash outlay would be a little bit more. Now, I want you to look at the maximum risk if you bought that insurance. If you bought just the stock, your risk is $2,165. If you spend the extra $155 to buy the insurance, you can limit that risk from now through November to $520. So you couldn't lose more than $520, and your coverage would kick in below 18. Cost you $520. Now, this is always interesting to me, and this is kind of off topic, but I wonder how much it would cost me to just buy the $18 call. Instead of the stock. It cost me $540. Okay, so this is always interesting to me. I want you to compare these two risk graphs. Stock with the protective put, you've got $2,165 tied up in the stock plus $155 in the put option protecting you. Your maximum risk profile is $520. Anything below 18 would be max loss. Your break-even point would be here at expiration at 2320. And then you'd have unlimited upside potential between now and November. So if the stock ran out to 30, you'd make 700 some odd bucks. Okay, compare and contrast to just buying the call option instead of buying the stock and the put. $20 difference in price. A lot of times it's really close. $540 cash outlay, that's it. You don't own the stock, but you have the right to the stock at 18. Anything below 18 is maximum loss of 540. Your break-even point's at 2340. You have unlimited upside potential between now and November. And if it got out to $30, you'd make 700 some odd bucks. So that's the amount of capital outlay. Like if you wanted to speculate, and instead of spending your money on the stock and buying the protected put, which is actually a great idea because then you own the stock, you get the dividends if they pay it. And I think VIPS pays a dividend. No, they don't. If they did pay a dividend, you'd collect that. If you own the call, you don't get any dividends. But you could tie up $540 instead of tying up when you buy the stock. You'd end up tying up, what was it, 2165 in a cash account. In a margin account, looks like you'd be out about 10,000, or excuse me, about 1,082. So about half of the margin requirement, 1,082 versus $540. Kind of interesting concept there. So we've learned a few things tonight. We learned a little bit about put options. We've learned about protective put options. We've learned about callers. And we even dabbled in just buying a call versus buying a protective put, like a stock with a married put. So we covered quite a few little topics here in the hour. And I try to keep these right to the 1 hour time commitment because I know you guys have lives and you have, probably got to feed your kids at some point tonight, stuff like that. I'm kind of in the same boat. So I'm going to go ahead and call it a night. But before I do, I want to give everybody else, all the newbies here, especially if you're having fun, you're enjoying yourself. First of all, give us a like and a subscribe on the YouTube channel. We go live every day on the Halftime Report. We do these Wednesday webinars every week. And then we have our free trial over at Tackle Trading. And we'd love to have you come check us out and get to know us better because we really do focus on the education before the application, and we'd love to invite you to come out and join us and check it out. We'll give you a little onboarding, hand holding, show you how to do, where to go, what to learn, and you can start getting our reports and the training lessons and everything else. Important lessons to learn. Yep. So education before application. Appreciate everybody coming on out. Have a great night. We'll see you guys tomorrow in the Traders Lounge. I'll be there. For all you pro members, we're going to be live in the Traders Lounge. And I'll also probably be there during the halftime report. See you guys. Take care.